So yeah, so in the T12 there was a repair and maintenance line item of $22,000.
Yeah.
And so we're like, these are 16 units. What costs $22,000 to repair? And what we discovered was that there was an HVAC repair in one of the months, but the other one was a capital improvement, meaning it was money they spent, I think $8,000 per unit to turn the units and upgrade them.
Right.
Now that is an expense that needs to be accounted for in the T12, right? In the profit and the loss, or the profit and the expenses of the business, but it's not an expense that we need to underwrite as, hey, when we take over this property, what are our monthly expenses going to be?
Right.
Right. Like if you look at, the Premier Club T12, Randall, that if you go back and look at that T12, it's got the rent, it's got the expenses, it's got then I think it says the debt payment, then it has the capital improvement as a separate line item.
Right.
Right. So that affects your NOI obviously on a month-to-month basis, but it's not something that needs to be factored into our underwriting.
Right.
Yeah. So yeah, so I think because now we're estimating about $8,000 repair. And guys, this is, starting, have you ever heard of Stephen Covey? This guy, this kind of like inspirational speaker. He's a business. I think he's dead now, but he wrote the book, The Seven Highly Effective Habits. Seven Highly Effective Habits of Millionaires or Billionaires? I forget the name of the book.
Successful people.
Yeah. Oh, is that right, Benoit? Yeah, Stephen Covey. Yeah, 7 Habits of Highly Successful People. 7 Habits of Highly Effective People. Anyway, he says in his book, and this applies in real estate, is you begin with the end in mind, right? And that applies to your personal life. Like for me, I always think like, well, what are people going to say at my funeral, right? Who's going to give my eulogy? What are they going to say about me? Right. So that's kind of beginning with the end in mind. But in real estate, when you're underwriting a deal, begin with the exit strategy in mind. Right. And it's the same principle. And so the reason why this Premier Club deal, this 88 unit deal, I talked to a couple of brokers and property managers about that. I mean, it's 88 1 bed, 1 bathroom deal. 88 of them. Right. So no mix in the unit break, unit makeup. I mean, so now this guy's having the same exit strategy problem that we would have if we bought that deal, right? Same problem. Like, who's going to buy all 1 bed, 1 bath?
Right.
Right. So, so that was a reason, that was enough of a deal killer, I think, to not go down that route. Right. Anyway, so when we're looking at the exit strategy, we got to look at where do we think cap rates are going to be, right? Because the exit price is going to be a function of NOI and the prevailing cap rates, right? And so where do we think cap rates are going to be? That's going to be a bit of a guessing game, but we can do some research. We can talk to brokers. We can figure out, where we think it's going to be, and then kind of ballpark what we think we can get the NOI to and what the exit cap's going to be. Now you may or may not hit that, right? I mean, if we do, then we obviously did good underwriting, but we could hit it early, or we could underperform. I mean, obviously you don't want to do that, but it's just, those are the risks that we got to look at when we're thinking about planning the exit strategy. So how are you feeling about that, Randall, now after you did the research?
Yeah, I mean, I'm feeling pretty good. I mean, from what it appears that even if we do shoot for the 2.7, we can still conservatively make it work, per se.
Yeah.
I mean, even if the cap doesn't go anything past 6%, we still get a great return for our investors. So I'm feeling a little bit more comfortable pertaining to that.
Yeah, yeah. And it's interesting too, is this one had assumable debt.
Correct.
Wow.
3.22%.
Super low.
But here's what we found out in doing the underwriting and doing the model, is that the returns are actually lower if we go with the assumable debt, because we're bringing in more cash.
More capital.
Right. So in that instance, I think based on your text, Randall, I mean, I think we should probably,
go with our own mortgage.
Just go get our own mortgage. Yeah. And it's obviously, it's got a Freddie Mac loan on it already. So Freddie's familiar with the property. We just got to qualify as the new borrower. And then I think maybe we offer 2.6. Because I had a conversation with him. It's funny. This is a tactic I use in mediation too. Is like, it's like brackets. It's like, if you go to this, will you go to this? Right, when you're negotiating. So we were at 2.5. He's at 2.75, and I said, well, if we go to 2.6, would he accept it? Or would he come down to 2.7? And if that's the case, then the price may be between 2.6 and 2.7.
Right.
Right.
I agree.
Yeah. And if these guys need to sell it, and we're good buyers, I think we can. So maybe we offer 2.65, just go in between.
Okay, I can see that working.
Because they gotta put a little, like in a negotiation. If it's a true negotiation, neither party is usually happy with the outcome, right?
Right.
We're gonna pay more than we think we should. They're gonna let it go for more than they think they should, right? And that's when you found the right price.
Right.
So, yeah, good. And then what else? Well, Benoit and I actually looked at a deal recently. He found a good little. How many units was that, Benoit? It's kind of in your backyard.
Yeah, 8 units.
Yeah, 8 units. In his backyard. Let me see if I can pull that up. I think my email is. Oh no, it's working here. What was the name of that again? It was Golden something, right?
It's in Golden Gate.
Oh, Golden Gate Apartments, right?
Benoit, you're in Atlanta, right?
Who, Benoit?
No, Florida.
Oh, you're in Florida. Okay, that's right.
Yeah. You are in Atlanta, are you?
Yeah.
Yeah, so this is another little 8-unit deal in Florida. And, Benoit, I think we need to underwrite this one.
Did he send you the T12?
Yeah, he sent me. So, yeah, see, look, I'll share my screen real quick just to show you guys if you can see it. He sent me this. This operating statement, I guess, from January to July of 2024. So I think I asked him for the full statement. But here's another.
But I mean, do you think it's fishy that he hasn't sent it to you after 24 hours? I mean, I would think, if I was the guy, I would send this to you in a couple hours, or the next morning, when I get my email.
Yeah, I don't know. I can't. Did I email him for it? I can't remember if I did.
Well, yeah, because last night, he sent you that, and then you said, "Can you give me the full T12?" And you asked him that at 5 o'clock last night, right?
Yeah.
And it's like a day later, and he still hasn't responded. To me, it's I don't know.
Oh no, they said they requested the February numbers. We'll get them as soon as we can. But it's kind of talking about what happened with Randall. Randall, look at this. This has negative NOI.
Wow.
Right? Negative NOI here. So that's a problem. But look at their maintenance expense. These are probably the capital improvements, not really maintenance. So we have to dive into that.
I'm dealing with an 8-unit. It's no way.
What's that, Randall?
I said it's an 8-unit, so I can't see them spending $50,000 on annual maintenance on 8-unit.
Right. No, not at all. So then, let's see where this is. I wanted to pull up the rent roll. So if we go back to the rent roll. But look how much these things are renting for. $2,200. This is $2,395. This is $1,800 because they're actually really big. They're like 3-bed, 2-bath.
Oh, support.
Properties. This is 2-bed.
Oh, I thought they're two bed, two bath.
Oh, they're 2-bed? Okay, hold on. I thought they were a 3-bed. He
I
doesn't
mean,
have enough. Yeah,
they're less than they're less than 1,000 square foot. That's small to me.
oh, I thought they were more. So here they are, an 8-unit multifamily deal. They're right here. Let me show you the. Yeah, right here they are. So I mean, they look, it looks like it's in a decent area. There's some other multifamily over here. It looks like a typical Florida type of property. Yeah, rentable square feet, 7,000. So built in 84, so that's good. There's 2 buildings. They're asking 2,250,000 for it.
What do you say it's good? It's built in 84. I mean, what would be
Yeah.
bad?
So the reason why you don't want any older properties like 60s or even 70s is because of the what we call the guts of the property. So, the older ones have copper wiring, which Fannie and Freddie will make you replace, and copper piping, sorry, and then also copper wiring, and the wiring needs to be aluminum wiring. So, and a lot of if they're really old, the electrical boxes in each of the units would need to be upgraded as well to current building codes. But 80s properties are usually compliant, but that's something we'd have to look at.
Is this in Tampa?
This is in Naples.
Naples.
Ooh.
Okay.
It's nice.
Yeah. Yeah, you're right. 8, 2-bed, 2-bath. So roof replacement 2020, 100,000 in recent capital improvements. So that's good. New windows, parking lot maintenance. The household income is really good in that area, so they can obviously afford it.
Naples.
Yeah, each unit is equipped with washer and dryer appliances. This is just more about the property. Oh, the upgraded ones. Oh, I see. Wait, upgraded. The rent's getting about 1,900. This is about 2,100. Okay. Oh, so here, yeah, I was gonna. So this again, these look like black appliances. So in the grand scheme of in the grand scheme of appliances, typically stainless steel appliances are more favorable, right? And if you look at the upgrades. Yeah, so average household income. I mean, yeah, okay. Naples is a great place to live. Some of this stuff I don't. The rent comparables. See, now this is always good to know. Our subject properties here. What are the rent comparables here? No occupancy comparables. What we really want is the sale comparables. So net rent pro forma. So that's
What
good.
does pro forma means? What does pro forma mean?
Yeah, so pro forma means it hasn't happened yet. It's not, so you have what's called in-place rents, and then you have like pro forma is what you are expecting to how you're expecting the property to perform. So they've got these upgraded units, the renovated units, and then the pro forma. Pro forma units means, the seller thinks they can achieve $2,400 a month in rent if the rents are
When?
upgraded
But when would that be?
well, after we upgrade the units.
Yeah, but 5 of them are already upgraded and they're at 21,
This is what we need to confirm with him, because I don't understand the difference between upgraded $1,900, renovated 2,177. What's the difference between upgraded and renovated? Right. And maybe he's just saying, I think what he's saying is the market rent, pro forma typically is market rent. The market rent is $2,400 in that area based on these comparables. So even the upgraded and the renovated units are under market.
Yeah, but then I don't believe that because, well,
Yeah, why not? Look at this one. This comparable here, 1985, two bed, two bath. There's 34 of them. They're
yeah,
about the same size. They're getting $2,400 a month,
yeah, I guess.
right?
I mean, it's still 100 foot square more. I mean, which is, about a little over a tenth of the space additional.
Right. Right. But these are the things. I mean, Benoit, this is, you're thinking about it critically, which is the good thing,
Hmm.
right? You're thinking about it critically because this is, finding a way to not buy the deal, right? If we don't think we can achieve those rents, then when we underwrite it, then, we need to decide if it's worth it or not. If we think, obviously our price is going to come down, and if our price comes down, our returns would shoot up if we think we can only get, say, $2,200 a month.
But then it's like, I mean, you can only increase rent after the lease ends, right? So this guy, say if we buy it like, in March, right? Well, what about those three guys that sign a 1 year lease and January 1st? I mean, that means we can't increase these people for at least 10 months.
Yeah. Yeah, well, sometimes, and something we haven't talked about, guys, is when, and I'm glad Dante joined, when we get into actual due diligence of a property, one of the things we have to do is 100% lease audit. Okay, and 100% unit walk of each property, right? So and that's a big undertaking. It'll take 1 or 2 days where we actually have to coordinate with the property manager. In larger deals, I mean, obviously an 8 unit in Naples, it won't take very long at all. But in larger, 50, 60, 70 unit deals, you've got to coordinate and get into every single unit. And so you got to be dealing with people who are living in there, cats, dogs, kids, neighbors. You're going in because you got to lay eyes on every single unit to see if there's any skeletons in the closet, literally and figuratively. Right? So, that's a big part of the actual due diligence, and you can hire companies to go do that for you. Obviously, it costs a lot of money. I mean, you'd spend 10 to 20 grand doing that with a company, or do it yourself. And then the lease audit is comparing the rent roll to what is on the lease, right? And just you're literally opening up a spreadsheet, you're putting in the rent roll. You're verifying all the data that's in the lease. And what I was going to say is some of the leases will say, you can, if the ownership changes hands, then the new owner can increase the rent.
Hmm.
But we have to look into that and see if the leases say that.
Okay.
Right.
Yeah.
And so, but to your point, Benoit, when, someone, if the idea is we're going to upgrade these units just because the market is higher, you can't just, usually you can't just go into a new apartment building and say, hey, I own this property now, I'm going to increase your rent $200 a month. They have a lease, that's a binding legal contract. You usually can't do that. But the amount of attrition and the amount of turnover in these properties is it's pretty consistent. So, when someone is late, you can evict them and get them out. When you get them out through an eviction process, that's when you can turn over that lease and charge the higher rent.
Or you can just wait till the end of their lease. Like, say if their lease ends in September, you let them know a few months ahead of time. Hey, to renew your lease, it's going to be 2,300 instead of 2,200.
Exactly.
But but I mean, if I'm buying the property, though, I mean, I sure am, thinking about the money, right? But at the same time, I mean, I feel like, right, don't do to others what, do to others what you want them to do to you, right? But I'm not sure that I would go, that I'd feel like it's fair. I wouldn't feel comfortable, say, to you know, say increase the rent by, like, 30%, right? If the same people are staying in there, right? Like, I'd feel like,
Right,
okay,
right.
I haven't upgraded your apartment, I haven't done anything. And now, because I'm the new owner, I'm upgrading this by, 30%. I don't know. I just feels like, um, something's wrong with that, I don't know. I mean, I'm fine, like, upgrading them maybe, 5-10%, but, beyond that, it feels it's kind of, I don't know.
Yeah. Well, you're a landlord. You're not supposed to have a heart. No, I'm just kidding. I'm just kidding. I'm just kidding. I mean, yeah, that's a consideration. How much would you increase on a particular tenant, especially if there's a long-term tenant that's been there for 10 years or 20 years. I mean, you'll find some of these deals where they've been a tenant since the mid-90s living there, right? And their rent is so low because no one's going to increase the rent on that nice old lady.
Mm-hmm.
So I'm just looking at the projections here on this one, guys, and look at so the net operating income. I wonder if this is so look, take over M&M projections.
What's M&M?
I don't know what M&M is. Maybe that's
Oh, it's the name, Marcus and Millichap, right?
oh yeah, Marcus and Millichap. Right, Marcus and Millichap. We need to look at the actual, so we need to look at the in-place rents versus the projected rents, right? In their projections, they're projecting a 4% vacancy, 0.5% for bad debt. So you've got your total effective income, your total effective gross income, 193,000. And then your expense ratio, this is something that you guys, should understand as part of your underwriting. It should be 50% or less. Here, the expense ratio is 31.53%. So that's very good, right? But this is not in place operations. This is pro forma operations. So then they've got your debt service of 100 grand, 106. So cash flow after debt service, $25,000. Yeah, see, these are their assumptions here. Year 1, 2, 3, 1. Okay, yeah, this is all their assumptions. And Marcus and Millichap, they do have they have a debt brokerage arm as well. So here, yeah, they're looking at 6.25% of an interest rate, down payment of about 900 grand. My lawn guy's here, so sorry if you guys can hear that in the background.
So, I mean,
Yeah.
so what's this loan amount? Would that be the loan that the people buying it from them would get, or is
No,
the
that's
loan?
what we would get.
Well, I mean, that they want to sell for 2,250,000. You're not going to get a loan for like 50% of, or like 60% of that.
Yeah, you would. You'd probably get a loan for 75% of that.
Yeah, but
1,687. So yeah, they're looking at I don't know what that let's see. Divided by, yeah, so that's a 60% loan to cost. But I think I think we could probably get better terms. I mean, the deal Dante and I are looking at, we've got, I think we're at 73% loan to value, right? Or 75, Dante?
75.
75, yeah. So I've got better debt guys that can do better deal than 60%.
because the more loan you can get, the better, right? I mean, if you can get a loan for 85%, you take it, right?
Yeah. Usually the higher, because look, your levered IRR is generally going to be a bit higher than your unlevered IRR. And that's kind of what we had in Randall's deal, because Randall's deal, even though the loan assumption was so attractive, it's 3.22%, right? It's like free money. But we ended up, because we had to bring in more cash, the returns actually dipped. right? Because we're putting in more capital. So there's more, there's more capital that has to be invested and returned. And so that's why the returns are a little bit lower. Yeah, this is the guy I talked to, Sam Ferguson. Oh, Randall, funny enough, look who's calling me. This is the broker.
Oh wow.
Take the
Oh,
call.
Yeah, let me take it. Let's see what he says.
Yeah.
Hey man, what's going on?
Hey man, I just want to let you know, dude, that I screwed up that communication because I spoke to the seller yesterday about those extra repairs on
Yeah.
the actual 212. Those are actually repairs, and he did keep the renovations off and separate into the capex. So
Oh,
that's
really?
my fault. Yeah, I just I guess I misunderstood what he was saying yesterday. So when I sent that originally, I was like, you know what? Let me go and ask him. And I had a call with him about 10 minutes ago. So that 8,000 and 8,000 on back-to-back months, those are actually for an HVAC system, and general repairs to the buildings and installation of the HVAC system.
Okay.
So yes, those are included on the NOI. I apologize for that.
Yeah, but those are still sort of capital expenses. I mean, those are deferred maintenance expenses, I would say, right?
Yeah, I mean that's what the way I looked at it, but a lot of those repairs, are just like servicing a lot of this HVAC systems because you'll see like it's about 2,000 almost each per month.
Right.
That's actually what it is. But I mean, if you consider that a capex, hey man, I'm on board with you.
Yeah, I mean, because you're not repairing a capex every year, right? I mean, not a capex, sorry, preparing an HVAC system every year.
Correct.
Yeah.
And they pretty much serviced and updated most of the HVAC systems on site anyway. So I think that was just part of one of the last ones that
Right.
they had like a long-term tenant in that moved out in November.
Got it. Okay. Well, we're we want to come back to you, but we're the seller's going to have to give a little bit, just like any good negotiation, neither party's going to be happy. So you got to make sure he understands that.
Yeah. I did discuss with my broker about decreasing, our commission pointage, especially if you come back at 2.7. And we are on board with that. I mean, I'd love to get 2.75 to put in front of them, but if at the very least you can come back at 2.7, I'll make it work.
Yeah, we may come back at 2.65.
Okay.
And and a quick close. So, what do you think he'll say to that?
I don't know.
Really?
Yeah, I mean, he was pretty firm. I mean, he kind of bit back at me yesterday evening. He's like, I don't have to sell this, but this is just a property that we were just open to selling, and this is our number. And I'm just like, at the end of the day, Mr. Tanow, like your valuation is a little bit too high because between my off market push for about 6 weeks, and then also now we've been on market for about 2 months now. I'm getting the same numbers across the board. So the strongest offer that I got was 2.6, but it had an owner financing piece, and that's just something that they weren't interested in.
Right. Okay. What do you charge? You charging 5%?
So we're at 6 right now.
Okay. Got it. Okay. Okay. All right, man. Let us do a little pencil sharpening, and we'll get back to you.
Yes, sir.
Thank you.
All right. No
Bye.
problem. Thanks, Todd.
Interesting, huh?
Mm-hmm.
So he's at 6%. So if we came back at 2.65 times 6%, that's 150 grand.
Mm-hmm.
So that's 159,000. So we just say, look, we're 2.65. Add 100 grand from your broker fee. See, man, brokers make so goddamn much money, and they just they always get paid the most and they work the least, in my opinion.
Right.
But we can go back at 2.65 and he throws in 100 grand from his broker fee, still makes $59,000 on the sale, and we're good.
All right.
Yeah.
Yeah, we can definitely
Right.
give it a try.
Yeah. Yeah, I don't know, but I don't know what, these repairs though, Randall, are
Yeah, that's what I was gonna ask, because I heard him also mention something about $2,000 monthly.
right.
So that I was a little bit unclear on.
Yeah. Yeah. Did you send me your most recent underwriting?
No, I didn't, but I can send it to you. Which
Yes.
one you want it? You want it from with us assuming our own mortgage, correct?
Yeah, without assuming the mortgage?
No, with us obtaining our own.
Yeah, obtaining, yeah.
Okay, I'll send it to you right now.
Yeah, but interesting strategy, guys, how you can squeeze the broker a little bit and they can take a little bit less of their fee, as a strategy to get the deal done, because that's going to go in the seller's pocket at the end of the day. Right?
Mhm.
Awesome. He's back.
Yeah, I'm back. I'm back. I lost my cat for a minute. But he was in the front yard.
Okay. Awesome. All right. Very good. Well, we can look at this. Let's see. Randall, did you send it over?
I'm doing it right
Yeah.
now.
All right. What else? What other questions do you guys have? If any.
I'm wanting to come back to that property we looked at, right?
Yeah.
Um, so, I mean, these guys seem to have an office in Tampa, but you were saying that they only have one property in Florida and trying to get out, right? So how would they have
Sent.
office in Tampa if they only have one property?
Where did you see they have an office in Tampa?
I guess it's on the OM.
Well, you're talking about the broker, Marcus and Millichat?
Oh, Marcus Millichef is a broker.
Yeah. So they are the actual broker. They are the actual broker of record. So
What do you mean?
that's not the actual seller.
Okay. What do you mean by record broker of record?
So that means the actual seller hired them to sell their property.
Okay. Okay, which is why they're based in Tampa, because they probably specialize in selling.
Yeah, I mean, yeah, these guys are all over. These guys are all over the country. Marcus and Millichap is one of the biggest brokers, in America. And they do a ton of multifamily. I'll actually introduce you to some down there in Benoit that you can meet up with. I actually think the guy who has this listing, Sam, would be a great person for you to just grab coffee with.
Mm-hmm.
And whether we do this deal or not, get in his records as a potential buyer. And so when they have new listings come of record, and they've got new listings that they are going to bring on the market, you'll be one of the first to know.
Mm-hmm. So what I could ask him to what if I ask him to tour the property next week?
Yeah, you should.
Yeah.
Yeah, I mean, I was gonna try to come down and do it with you.
Well, that's better, right?
Yeah. So we can look at it together. Oh, there's Sam. There's Oscar. Yeah, sorry, Oscar. I think if everyone can see that joint Telegram chat as well, because I added everyone to that particular chat. I want to make I want to make sure that we're clear that the standing call now is going to be at 5 o'clock on Tuesdays for the group call. Just because it's easier with dinner time and kids and all that sort of stuff. For me, I was getting funny looks from my family.
Okay. Yeah, because I was expecting to jump on at 6.
I know, Oscar. Yeah, I appreciate that. Yeah, but Benoit, I think we should go tour the property, but let's underwrite it first. Yeah. And I want to make sure you have the model, and if you can watch the Loom video on how to manipulate that software, that Excel spreadsheet. And you and I can go through it obviously on our one-on-one call, but I want you to take a stab at it and just get familiar with some of the information, okay? And it looks like most of the information we need is in their OM. But I'm gonna email Sam actually right now and see if he can send us the actual.
I shot you over that email, Todd.
What's that?
I shot you over the email.
Oh, got it. Okay.
I mean, I was listening to some guy, I don't know, earlier today even, but how and he was saying like, you really don't want to take any numbers from the OM because he said that's just marketing, He said I don't even look at the OM.
Well, right. I mean, but sometimes the OM has what's called the in-place rents. And if the OM has the actual in-place rents, then you can use that information. What he's talking about is the pro forma, right? The pro forma is the projection, what the brokers think the property will perform at, under new management or new ownership.
Mm-hmm.
Right? So that's the difference there. Let me let's see, Randall. Let me pull up your email here. Oh, here we go. Cool.
You see, I changed those repairs to that 8,000, but I'm kind of wondering, do you think we need more clarification? Because I didn't really understand them that well.
What'd you say? Did we need what? More
More
clarification?
clarification on the repairs, because I didn't really understand the broker that well when he started saying that it was $2,000 a month to oversee each unit. So I was kind of thrown off on that.
Is that what he said? $2,000 a month?
At least that's what I thought he said. I can be wrong.
Yeah.
And that would be more than what was even on there. So that's why I didn't think that it can be true, because 2,000
right.
by 16, that's 32 grand,
Right.
which is above what they had on.
Let's just call him back real quick. He'll answer my call. Right, 7%. Hey, real quick, what did you say was $2,000 a month?
No, so when I look at the repairs, let me pull up my T12 real quick. Absolutely blasted by this gas station listing.
Oh, really?
Yeah, I just posted it last night, and my phone hasn't stopped ringing.
I know some gas station buyers.
Well, all right, I'll send you the offer memorandum.
Yeah, I'm looking at the T12 here. Hold on, I'm pulling it up 1 second. Yeah, so in looks like, let's see. Well, October they had a $4,000 repair, 4,300, and then November was 4,600.
Correct.
Right, and then May was like 3,500, and then February was 1,900. But then after that, and June was 1,245. And then after that, it's like 400 or 500 bucks a month typically. But
Correct.
did you say it was $2,000 a month to service the HVACs?
No. What I was saying is it was around 2,000 per month once you put all the numbers up together over the last 12 months. That's what I was saying.
Oh, right.
So once you add up all the numbers, the 400, the 500.
Yeah. Well, the total repairs is like 22,300 basically. Okay. And we're just curious if that's indicative of the actual repairs, like the R&M line item as an expense that that we should be underwriting to. That's what we're trying to figure out, because a lot of these kind of, I would say, deferred maintenance costs would be we would have reserves for that in our underwriting, right at because we would have a reserve of like 300 bucks a unit in our underwriting, and so would we need to include that in our model? That's what we're trying to figure out. And are those are kind of extraordinary repairs, because you said it's HVAC repairs, right? I mean, they replace the whole unit.
That was a complete replacement. That HVAC, that 4,000. Let me see where. I'll go to send me earlier just to confirm.
Yeah.
We had to replace the HVAC system in one of the units. The charge for the parts was $34.46.67, which was in October, and the charge for the install was $26.57, was in November. That's why each month was higher than normal. That's what he said.
Got it. Okay.
And any questions that you have, like I can go directly to the seller and get that answer.
Yeah. Got it. Okay. All right, man. Thank you. I'll keep you posted. Thanks. Bye.
Yes, sir. No problem.
All right. So yeah, that's just, I don't know. That's kind of interesting. I mean, I would still, because in the model, Randall, we've got $300 per unit for reserves.
Right.
So let's see, where's that reserve amount? So I mean, we're going to be, that money's going to be sitting in the account anyway. We're going to be collecting that, as part of our annual monthly expense.
Right.
So I still think, if we budget $8,000 a year for repairs, I mean, more, you probably know this better as you're in your property management experience. What is typical? I mean, these are 16 units. I mean, that's.
Yeah, I mean, 300, especially if we're budgeting, what is it, 300 in reserve per unit per month, overall.
I believe it's per, I believe it's per unit per year, maybe?
Per year, so what, 4,800?
Yeah. Yeah, exactly. Yeah, I mean, listen, that 2.65, this is still a strong deal.
Mm-hmm.
We've got the project level IRR at 22. The sponsor IRR is obviously is good, and then you're still at you're at 18%.
Right.
And
that's at a 6 exit cap. Now, if the market, goes according to plan and it drops down to a 5, we're looking at over 20%.
Right. So when you move that to a 5, then here we're at 22%. And I mean, the market, we probably won't sell this thing for, 3 or 4 years.
4 years easily.
Right. So it's definitely going to come back. The cap rates are going to compress likely during that time period.
Right.
So, yeah. So I think let's just go back at a 2.65.
Okay.
And to go ahead and revise the offer to 2.65. I think take out the seller financing or the financing assumption, the loan assumption, and just say. But I would put in there that we still want a financing contingency. That the purchaser's obligation to close is still subject to acceptable agency financing.
Right.
And then let's get it off. I can send it back out. Or if you want to, you're on the email with Matthew. I think you can send it back to him.
Okay.
Yeah, and I think in the email just say we're hoping you can make this work. By doing whatever you need to do with your commission.
Okay.
you know, just squeeze those guys. I mean, hell, they're gonna make more money than all of us on it.
Right.
One other thing before we go, I get these random emails all the time. I don't know how many, emails I'm on about offerings and deal offerings. And so I wanted to show you guys one that I got recently. Let's see. Gaps. Hold on 1 second. Yeah, here, because eventually, this is the type of email when you build your email, marketing list, right? This is the type of stuff that that we want to be seeing from you guys when you build, and that's why, using Go High Level or using some sort of software that aggregates the email addresses for raising capital. Have some of that software. I think Dante, you use Go High Level, right? I think Randall, you've got something that is in the works.
Yeah, I have Go High Level.
Yeah, I mean, Go High Level is awesome. But anyway, so this is an email I got. Again, I don't know these guys from Adam, so I hope to God it's a 506c offering because I don't know them at all. But they somehow got my email address, and obviously they got some issues with their graphic design. But 297 Class A apartment, including a video tour, I thought was a really cool touch. For if you wanted to have a drone and do like a drone flyover of the property, I thought that's a really cool idea. And then look, submit soft reserve, right? So that's when you're raising capital, you want to submit you want to show, and this is just a Google Doc, right? It's a Google Doc that goes into a spreadsheet where you can list how much you want to invest. Your probability, your state of residency, how was it funded? How'd you hear about the deal? Right? All of this can be done through Go High Level, through their marketing platform. And then when you click on the actual email, I love this. We always see this. Why are we excited about the deal? Right? You want to tell your investors, why do you love it? Right? I mean, if you're not sold on it, why are we going to buy from it? Why are we going to invest with you? Right? So why do you love the deal? So anyway, obviously we can read through that. And then they have they've got some 3D walkthrough images, the investment summary. Again, submit your soft reserve, some highlights of the returns, 10%, projected Class A return over a 5-year hold. Have those investment metrics available. And then if you look at their investment offering, it's a very detailed, I would say, sophisticated offering. Obviously a really good disclaimer here. Information about the lead sponsors. Again, I don't know these guys from Adam, but I like having the bios of the sponsors. It gets you to know them a little bit more. I mean, they have a 56-page summary. That's obviously way too long, in my opinion, right? as an offering memorandum, but it gives you a good overview of kind of the key topics. Here's some key financial metrics. Oh, it is a 506c offering. Look, so it's accredited investors only because they want to advertise, right? When you're gonna advertise deals like this, you're gonna send it out to 5,000 email addresses that you don't know. You have to do it through a 506c offering. It's a huge deal. Look, I mean, they're raising $26 million, for this Class A asset. They're buying it directly from the developer. The debt terms, and then they have a good market overview here, which I thought was helpful. Some of the stuff we have in our own offering memorandums, but I really like this as a template, right? As an example of what kind of offerings we should be looking at. You got any questions about that? Spartanburg. Submarket. You know, just a lot of data, a lot of information. This one's a little overwhelming to me, honestly. Best in class amenities. It's a class A property, so this is not what we're looking at right now. Unit mix. And then here, you know, here's their business plan. Look, unit improvements, convert studios to 1 bedroom, enhance customer service, expense management, improve signage. You know, so even as a new build, they still found some ways to add value to the property. And so look, they're going in cap rates 4.46. And look, so you know, Randall, we were talking about the return structure. You know, I'm thinking 18 or above is a good deal. You know, these guys are between a 14 and a 17%.
Right.
Right. I mean, just that's the market these days. I mean, a couple years ago, it was 20 or bust, right? 20% or bust. I feel like nowadays it's a little bit lower, and people are you know, investors typically accept that.
Got it.
Got it. So, but here, remember I always said hypothetical class A, hypothetical return structure of $100,000. They're offering 10% cash on cash. And then I guess you get your $150 return of investment there. See, equity, I mean, this equity multiple is not great. 1.5. That's not, you know, you invest 100 and you get 50 back. You know, I don't love that. Oh, I guess, see, these guys have 2 options. The first option is a straight 10% return with no upside, right? So you get your 10 grand for 5 years and you get your capital back. The second option is you get less cash up front. Look, your cash on cash is a lot lower, but then you get a much higher return on the upside. So it's possible to structure deals like that within the same deal, right? You just got to underwrite it that way. And I've got models that will help us do that. There's also, go ahead, Benoit.
I mean, I was saying in a sense, I mean, you try to tailor the, you know, the deal to the investors, right? So try to, what they prefer. Some people like would rather have more money up front. Some other people is like, yeah, I don't want it right now. Actually, I just want it at the end, right?
Yep, exactly. Some people want it. Yeah. So that's why you have the options. I mean, the options are good. It does make it more complex. I feel like a little more complicated just in the underwriting. But, you know, there's models out there, and I've got models that I can use if anyone wants to go down that route. I think for the first deal, you know, that's not something we want to look at. But when we grow and scale and we get to larger deals, you know, and you're getting with larger investors, I mean, really, you want to incentivize those investors that are giving you, you know, $500,000 checks. You know, those are the guys that you want to incentivize larger checks because it reduces the amount of investors you got to deal with. So. Cool. Awesome, guys. Well, that's about time is up. I guess, Johnny, send me that sketchy deal. I'll call it the sketchy deal now, and we'll look at it. Good to meet you, Eugene. And then yeah, keep pinging me on stuff, guys. We'll get these deals closed soon enough.
Yeah.
All right. And all right, buddy. Take care, guys.
Take care.
Thank you.